to manage your risk as a trader, you've probably heard that stops are a good idea, but a loose stop versus a tight stop, how do you know where to set it and what's that look like? Our guest today is Pratik Patel to talk about how he does that. So Pratik, first of all, how do you set stops in terms of, is it a specific dollar amount or a technical level? What do you like?
Sure. Well, I'm a tech trader, I'm a trend trader, so I'm going to wait for certain things to develop first. If I'm looking for a uptrend, I want for those higher highs to be established, the higher lows. So I'm looking for, the trends or a pattern. And so once I establish a setup that I like, that's, going according to my criteria, I'm going to put in my entry order and I'm going to put my stop. But I place my stops at technical levels, like could be a double bottom, triple bottom, a trend line, support, resistance. And I keep my stops 1 or 2 ticks below a major technical point. Reason being is what I've seen in my experience of being a tech trader for the past 8 years is the markets respect technical analysis. So if I were to, let's say, a lot of people like to use, a tight stop of I only want to risk $100 or $200, but they're basing that risk on their notational value that they can handle. They're not respecting what the market's showing. So maybe the market says, okay, well, the risk in this trade should be maybe about $400 based off of technical analysis. So what I've seen happen before is like people will put what they can handle as a monetary stop, and then they'll stop out, but it will see it bounce off some of these technicals. And that's also the reason why I keep my stops 1 or 2 ticks below a major price point, because sometimes you'll see those double bottoms keep hitting off, keeps bouncing off those levels, and if you keep that super tight stop, you might get stopped out, and then as traders we get into the emotions like, oh, I stopped out, I can get back in the trade. So it's more about I use technical price action and see what previously happened in the in the market, and then try to project what's going to happen in the future. So, and I've seen, keeping a loose stop, and that's, also when I use loose stops, I also look at technicals and say, okay, if the stop's at this place, and this is the risk I can handle, then I'll put that trade on. I'm not going to leave a super loose stop and let it ride. It's going to be in measurable means. It's going to be technicals and also a dollar amount. But it's not going to be purely, I can only handle a $50, drawdown and I'm out of the market.
All right, so if I can't handle to wait for it to come down to a 200-day moving average, the idea is not to take the trade rather than try to put the stop further within your risk management set.
Exactly. I mean, and also one thing about trading is if you feel like you're going to miss an opportunity, never feel that, because there's always going to be another opportunity. If you missed it today or you missed this 1 hour, I can assure you tomorrow's a new trading day. You're going to find another opportunity. So, and it has to deal with a lot of patience. Sometimes you keep that stop and you have to wait and see if it's going to bounce off those levels or not.
All right, Pratik, thanks for your time.
Thank you, Tim.